Hey there, I'm Samantha LaDuc, founder of LaDucTrading.com, and thank you very much for joining. This is Tuesday's edition of Macro to Micro Power Hour, and I am joined by Jonathan Gibbons very shortly, as soon as I promote him to panelist. So hopefully we can hear each other well and we can dig in. Hello, Jonathan. I want to definitely thank you for joining today because we're kind of, I don't know, bored by this chopping around business. And we're going to try and figure out if we're going to go higher, lower, or just continue to chop around. So, Jonathan, can you hear me?
Yeah, I can hear you. Can you hear me?
Perfect, loud and clear. We're getting kind of relaxed on these Tuesday things. We're both in t-shirts. We're like, okay, we're waiting for something totally wicked awesome to happen, right?
I was gonna beg for like a pass. I haven't had a haircut in like a couple months.
My
So yeah.
curling iron broke, so I just ordered one today. So I'm like, oh my God.
So
Don't
hopefully everybody forgive me. I'll bring my professional game next week or something, right?
I'm not
Yeah.
like I'm not even putting up if I can't curl my hair, I'm not putting a blouse on. So I'm
Yeah.
really just waiting for spring and a little bit of, pep here with some sunshine, but still also waiting for the market to kind of figure out what it wants to be when it grows up. So we kind of started this whole idea of talking today. By the way, those who are just joining us, let me just share a little bit of what we're doing here. So macro to micro power hour, the two of us, right? I really love Jonathan's view of market structure, and we kind of combine the macro with the technical and the sentiment and optionality. We try to make heads or tails out of stuff. This is, oops, sorry, that's the main thing. Anyway, you can find VigTech at VigTech.io, where my risk indicators are located. You can find both of us on Twitter, and then my YouTube channel, which is where I will host this video when we're done. So it's kind of funny. We talked about is Fed trapped? A week ago, I had a great segment with Michael Leibowitz on deflation risks. And anyway, every Tuesday, Thursday, there's a different feature that's very much macro, but very actionable, such as oil. And that's basically what I just wanted to say for housekeeping, where to go after we're done this little soiree. So let's get back into it. We decided to entitle this one, Breakout or Fakeout, because the longer the market takes to kind of digest these levels, it either gets, wears you out, right? It gets tired
Mhm.
and then starts to roll over, or it's a complete bear trap and it
Mhm.
shoots higher. So where are you at? What's your
Um,
guesstimate?
so I posted something out there on Twitter this morning, like when you looked at just specifically ARK, for example,
Mm-hmm.
and we're building our new options product, and the
Great.
last, let's say, 5 days has been nothing but like premium call side driven. So like of Tesla. So and
Mm-hmm.
it's overwhelming. Promote predominantly like SPY and QQQ and IWM. It's like from a premium standpoint, it's like totally overwhelming everything. And you go look at where Cathie Wood is sitting with ARK, right at this kind of hanging by a thread, like cliffhanger the movie on their the bull bear pivot on our side, pretty significant market levels from a structural standpoint, and that being the largest holding they had, right? So that was kind of my takeaway from the last couple of days, is like you have this one stock that is the premium on it is just off the charts, and then it's all not all call side but predominantly call side, overwhelming the put side, and you've got this ARK product that's kind of hanging by a thread with its largest holding. Can we turn our largest holding? There's some kind of underlying stories that I think are floating around, because when you don't have volatility, what is really happening, in my opinion, is like pockets. You have these pocket kind of situations going on, like the Momo trade is getting obliterated, but you don't see the major indexes rolling, right? You see IWM very, very violent, because it's got a lot of that inside it. A lot of those Momo trades are inside IWM index, and you don't see any of those in the DJIA. You don't see any of those in this, for the most part in the SPY. You got Tesla in the SPY. So when you look at this, like
I'm showing you the top 10, by the way, for the ARC
of
holdings.
Cathie, yeah, you
Because
look
I,
at like Teladoc, crushed, Zillow crushed, Zoom crushed, Baidu crushed. Shopify, roll. Most of these, the bulk of everything they have on their side is crushed, and so they gotta run with the Tesla. And it seems like, and they've done some things to open up some of the things that they were able to buy and how they were able to buy. They changed their mandate,
I
for the
saw that.
ETFs. And I think that's a lot of what's going on to an extent. Without volatility, you've got these pockets. So, that's one story, and there's a couple different stories, but, vol is just not, it's not playing the game at all. And I think that was kind of my biggest takeaway overall from the past week. It's like, the longer we sit here, there's no vol, the higher likely you could get a breakup in over 4,000, and that's going to be pretty significant for the SPX. And I'm sitting here seeing it. I see there's a lot of bearish sentiment. It seems to be anyway. Like you had the whole Tiger Cup explosion, right?
Wow.
Friday.
Wow. Yep.
Which is a total mess. But when you think about it, I looked down today and I saw that Goldman Sachs was like the highest performing on one of my watch lists, and I was just laughing. I was like, Goldman's out here parroting that the world's going to end and their stock's raging right now. And so it's just in the absence of volatility, things continue to rotate. I've been saying that for 4 or 5 weeks now.
Oh my God, this is the absolute best saying. You have a few of them. One is, of course, trapped.
Parabolas are trapped buyers.
Trapped longs equal liquidation. Yeah. And nothing is more apt than that saying, in my opinion, because you look at a Viacom, for example, or a Disca, and this was week after week after week until literally collapse. Same thing, obviously, with Disca. And Baidu had a really nice fall, but it still looks like it has more to go, et cetera, et cetera. So a lot of these are also ARK holdings, but that saying is huge. The other saying that you have, which is lack of volatility, you'll have rotation after rotation. And oh my gosh, this has been still fabulous for the value trade. And every day, I'm looking at this, which just as an example, we're still in a solid trend here. Yes, we can come down, but in comparison to momentum, which has broken the 10-week a while ago, and it looks a lot like the ARK and the Teslas, right? Where it's still, after 5 weeks, just has not gotten out of its way. You can see it's still on the 200-day, which is that green level. That's the 50-week. But they all look identical, which is similar to a pattern called an H. So an H pattern kind of does this kind of formation, a chair, and then it continues to roll over, but nothing has broken, right, as far as key levels. The one thing I will say that is above the 200-day, and I'm not going to show it with the dollar because this particular TC2000 doesn't show it, but my stock charts does, is the dollar index. So Dixie is above the 200-day for the first time in quite a long time. And interestingly enough, silver is below the 200-day for the first time since May 15th of last year. So, this is why I'm, listening very closely to what the market is saying, which is, we have lots of money coming in, right? There's still, in fact, I got pinged with that level yesterday. Hold on. Where was it? Someone just told me, and I said, that's so cool. Give me a second. Here it is. The Fed has injected 1.85 trillion in the last 8 sessions, 1.6 billion since yesterday alone. All part of that, not QE stuff. So we're still having tremendous, infusion of cash, and the market still isn't taking off. I mean, liquidity, excuse me. And, we still kind of digesting and deciding what to do.
Yeah.
Thank you, Sal. He's in the room. He's the one to send me that. I'm like, where'd you get that?
I'd say you haven't had anything except pockets. Like you got the Tiger Cup thing as a pocket. That's not a predominant, it's not going to market breakdown, right? Then you've got the LaDuc stuff, the triple D stuff. You've got all of those stocks and ARK. It's a singular story. I mean, ARK is the size of Vanguard, was, not now, but was, but not the entire market, right? There's so much passive capital that's still kind of on the buy side that it's just, the one time frame purchasing. And then you don't have the volatility, you don't get the displacement without the volatility. So all these things are like almost shaking themselves out. The weak hands get shook out. Tesla trade is kind of a singularity, but then it cascades over, but it's still singularity. It's its own trade. And so none of the major indexes have broken market structure. Even in NASDAQ, the NASDAQ doesn't look great, but the NASDAQ hasn't broken down, right? And so, without volatility, you're just not going to see these things can continue to consolidate. And so it's more of a, what could trigger the liquidity to begin to, find a desire to supply side versus buy side, right? Sell side versus buy side. And that's why I said last
Finding
week.
their way to the dollar.
Yeah, yeah, it's true. Yeah, it's because it's probably one of the only hedges, right? To an extent,
Totally.
right?
We talked about that. Where are the hedges? It's not volatility, it's not bonds, it's not gold. In fact, gold and bonds continue lower, which is my whole thesis, right? For months. They're not going to get supported for a while, unfortunately. Second
right.
half is still my call. It's still playing out.
Yeah, and that's been very apropos. Like without, and even these things are setting themselves up like, gosh, I was looking at you look at the Dow, right? And the Dow is really no components of that are soft. You look at Facebook and all these things that were the fangs that were really out of favor for a while as everybody went towards the momentum trade. Well, those have been doing all right, and now they're carrying back into the indexes. So we are because I did a breakdown for IWM last week, and I just showed real quickly like some of the components of IWM, and I was like, hey, why is IWM just vomiting on itself? But then getting back up, but then throwing up. And everybody's like, why, is that happening? Well, it's the composite components of the IWM are all of those, with the ETF having to rebalance as those Momo trades became larger and, got more call buying, they grew in market cap. As they grow in market cap, then the index is forced to buy more of them. So they became more of a market weighting. Well, as that's getting flushed out, IWM's real violent because now, but we'll have to see how that shakes out as those like LaDuc and all that kind of stuff now have gotten crushed. Will they, kind of reverse their weighting? Is this going to be natural kind of rebalancing for these indexes, or is this going to, take a bigger hold on it? And I think
go ahead.
The biggest gambit of the whole thing, and I go back to it, is if there's no volatility, if you don't have volatility, then the passive indexation, the volume of buy side transactions will just simply continue to provide float. And when you look at the SPY and you look at the SPX, and then you look at QQQ and you look at IWM, it's really kind of, that's how it's shaken out. And even when we get a little breakup in IWM and you get a breakup in QQQ is related to the volatility, right? It doesn't stick. Within a day, it comes back. Mm-hmm. And as long as you see that, you're going to continue to kind of get hit. If you're shorting, right, you're going to continue to see this just buy that's really it's really aggravating buy, right, to you, because you're like, this should break down. It should break down. It should break down. It's not going to break down until you see the volatility step in. And I'm just completely convinced of that until you see the change in the structure of the options, which is the number one reason why we wanted to build an options product that was past flows, right? Go past flows, right? Go and look at the actual, how does this thing laying out? Because you can look at this and you can see it. It's still call side. The bulk of the premium in the market is still call side.
But it's also rotating. So to kind of go back to that IWM analysis. So, I follow this rotation and try to anticipate it for clients. And then I'm, glommed onto it in my trading room. And then obviously the trade setups, everything has been safety. Like the best offense, has been a pure defense position, whether it be, oversold packaging staples basically, but also still industrials and aerospace and things that are typically very slow moving. And by the way, a beautiful low IV, speaking of optionality, not, in the 20s and 30s, not 120 and 130 like most of these 100%. Momentum plays. So they're absolutely gorgeous. I have a list of 50, my top 50 that are just stunning. They're not done. They look fabulous. So I still think this rotation into the value and cyclical trade is still very much alive, and it's also forced some of this factor rotation from momentum into growth. Hedge funds had, still their worst quarter. Some of them blew up, like last week. So where is the rest of the risk out there? At first, it was Credit Suisse was only going to have 2 billion exposure. Now today it's 7 billion. More estimates are coming in that this isn't, isolated to the four primary banks, but it's, obviously other hedge funds have been practicing this, ultra leverage type of routine. Personally, it's fascinating to me because the air pocket of leverage, or the pockets of leverage, create air pockets of risk. So we saw
Yeah.
that last week with the China plays and the Viacom and Discovery, and it was straight down 50% haircut.
Mhm.
Now they do look very viable for bounces. I can see calls of size coming in. I can see put selling coming in, and that's a great strategy. But the fact that it's busted, it broke, right? It
Mhm.
technically speaking, the sentiment
Yeah,
of
yeah.
it. How many people were kicked out, with their stops after a 50% crash in a few days? That was what feels like that could happen anytime, and to other sectors as well. But I'm also I've retweeted that the retail call buying has definitely been cut in third.
Completely. Yeah, yeah. That's down significantly. Robinhood, there was a something I shared the other day. It said Robinhood was in the top 20 at one point in App Store and Apple App Store, and they're not even in the top 200 or something. So don't quote me on this. Like 100 or 200 is like it's gone way out of favor. Having said that, there's still a significant amount of retail interest, and then there's a significant amount of options buying that's taking place. But what's to me is a bigger question, and I think Ken Griffin addressed this last week too, and I follow
When
him
did he
very
talk
closely.
last week? I
It
missed
was
that.
a Financial Times article,
Okay.
and they interviewed him, and they were, what was his number one concern is inflation, like real inflation. He's like, and I think that the real inflation is the probably the primary risk to everything, because that will handle rates in a totally different way. It would be forcing the action, like we've talked about extensively. So, I in the absence of vol, you're going to continue to see inflation continue to tick up, which is probably, you can't make everything, they can't create balance, right? And so we are imbalanced at this point, across the board. And like, I saw houses were, I've seen like 5 or 6 articles in the last 48 hours of 125 bids, 75
Oh,
bids,
it's not
85
just that.
bids, 95 bids.
Canceling, yeah, home builders
Yeah,
canceling contracts with inflation clauses. But the interesting
right.
thing to me is at the same time that inflation, and we've been on this talking about real and perceived inflation expectations, the Eurozone report comes out. I think tomorrow we have the Amazon union organizing vote, if you will, on Tuesday, which could impact wage inflation, right? I mean, if it spreads, it's got to start somewhere. Um, the whole thing, though, right now to me is, what does oil do? I know we're still stuck on that, and the
Hmm.
month isn't over, but I still see some weakness in oil before it shoots higher later in the summer. And I think we can have that kind of short. The heck is this thing I'm on right now? And we can have some short pullback in, what the heck is that? Sorry, Loom just popped up on my uh, some strange errant app. So I had this expectation, obviously, for higher yields, a higher dollar, but I think oil right now is in a really big chop area that's a little bit dangerous. It can pull back, pull down those inflation expectations as well, right before it shoots up like hot fire flames. So,
Yeah, totally, totally.
but
Yeah,
we'll probably hear the narrative in the next month of how, oh no, deflation's coming. If oil does roll over down to that 53, if crude rolls over down to that 53 area. But I think that it will solidify and test it again higher.
I want to go back and answer your question a minute ago, or you kind of reference your statement. When there's the air pockets of risk,
Mm-hmm.
right? Ultimately, when there's no market action on the buy side and sell side, so you just like everything is a buy the dip, right? When you get tested, right, across the board, you just get those zeros out, right? Like it's going from here to down 50%. And that's, we've seen it in the broad market. It's a little bit harder to see that action happen, and a little bit more violent and prevalent than in the single stock market. So like a single stock, it's easier for it to get wiped clean than it is for like the the whole index itself to be wiped. And so, with the indexation functionality as a market structure, where they're, taking this out and putting this in and rotating in all that passive infrastructure that's, indiscriminately buying. They're not indiscriminately selling it until you get real volatility. So until you get significant volatility, there is no indiscriminate selling in these ETFs for the indexation ETFs, the major indices, not like even like Cathie Wood, like she's so concentrated that it's once the ball starts rolling, it really starts rolling and gets overemphasized. So I think where I was going with it is the concentration risk is probably the bigger risk at the moment than the index risks, right? Because these concentrated positions can get liquidated very quickly. The index positions, because they're balanced across the board, until there's significant volatility where the ETFs by rule are selling, right, at their markers at the end of the day or at the beginning of the day, then you won't see that index kind of roll situation. And I know a lot of people are like looking for that, but I think you got to peel back how these things are constructed and what is inside of them for the big indexes versus maybe like a ARK, which you can look inside and it's all the same stuff, and it's leverage on top of the same stuff. And I think that's really, when you look at Viacom and you look at the rest of the ones that have blown up in the last couple of weeks, any of those Momo trades, the same thing. Those singulars can get lit up real quick. And that's what we are seeing. And so I think that is a big change. And I want to identify, it's like, I'm not sitting here being a bullish person, like, hey, this whole thing's going higher or what have you. I think from a market structure level, it can go up higher above the 4,000 level, even 4,400, 4,600. The Dow can hit 35, 37,000. These are without volatility, just based on the way that things are moving. But if you look at what has changed is now these concentrated positions are falling apart. And when they fall apart quickly, a few days. When you looked at ARK, for example, it's so concentrated, and I showed it in the chart I gave that it was February 20th roughly, and it broke these market structure parameters, and it just kept going. And it's really been a fight. I mean, they're fighting tooth and nail for that, but the problem is they're not balanced. And then you look at, like, I know a couple people have put out there, like the space one has like things that aren't even related to space, in that ETF. So it really is like something that I think is really important at this point, to look inside of the composition of these indexes as you're starting to look at where the market structure is going to turn, break, or hold on these higher levels. Because if they are balanced, then you've got that value rotation that you've been all over, then they probably will continue to get that indiscriminate money rotating inside them and to them. But if they're not balanced, they have run a high risk of getting blown up, which I think, I haven't done anything with it because we've been working pretty hard on building stuff. But I think it's probably something that people could explore right now, and that you could look and see what's really concentrated and what is not so concentrated. And what stuff that's concentrated could be really good plays. And I think that is it's more of a market of pockets to me, until the indexes are forced to liquidate. And so you could be getting alpha in the pockets where people are definitely overweight. And so I wanted to just circle back on that and kind of throw in my 2 cents, because I think you were right that there's significant risk. And I think that it's in highly concentrated ETFs and highly concentrated positions. And because we've been on this ETF kind of growth spurt for 5 to 7 years now, we have so many ETFs that really all hold the same things or really hold concentrated things. So they're not spread out indexation. They're really, it's like basically a basket of the same stuff. And so you get these huge IB positions in them as well. So for what it's worth, I think that I've seen that, and I've seen that appear in the options positioning as well, where you get these individual names.
Now look at this fractal, which I grabbed because Cathie Wood had come out and said a lot of value stocks are in harm's way, right? And so obviously I'm right now and have been a value shopper for months, because I really
Right.
as durability as a cyclical trade, things over paper. You can see it with real estate, right? You can see it with commodities and lumber and steel and what have you. Oil is a little bit different animal, but in any case, this particular, I meant to show that. Fractal was really clear when you're talking about concentration risk. Look at this, Tesla and ARK. I mean, fascinating, isn't it?
It's a singular trade. I mean, when you're that concentrated, and then if somebody had said something that's like kind of a gambler's paradox, or gambler's dilemma, where as you're if you're not like performing some sort of Kelly criterion betting structure, where you've got a structured betting program, like a programmatic, like Renaissance, all those guys employ, then you're able to become, well, I wouldn't say able to, but you potentially can get victim or fall victim to the gambler situation, where as things fall apart, you begin to double down, triple down, start to take much more speculative risk. And I think you're seeing that with her, kind of changing her mandates, allowing for more speculative and singular positions, larger positions. It's like they're basically, you're seeing one of the, and this could be like the one of the stories of our time, I think, in this period of the stock market, where something became as large as Vanguard by being highly concentrated, and then because it was highly concentrated, it could not stay there, and it became victim to the kind of the behavior that you get when you're highly concentrated. Things are really, really, really good, or things are really, really, really bad. And being speculative may not help that. So if they don't diversify, I think you can see that whole position fall apart.
ARK is way too specialized, but this is also, full of SPACs. And so Peter just asked about that, which is twofold answer, at least on my side. One is technically there is literally the SPAK, which, if you just do a fib level on this, when we first dropped very precipitously in 2 weeks, we came all the way down to the 78.6 level, bounced right into the 10-week, which was resistance, and then formed, a completely lovely on a weekly Morningstar reversal. And here we are right back down. So could this be a double bottom and head higher? It's still not safe until it's back above 30. Craig, who I've had, Samuelson, who I've had on, SPAC Attack 1, SPAC Attack 2, when he was trading this stuff, and I mean, he's just been a guru in this space. When on the first ride up, he was like, this is phenomenal. Then the second show was all about how, like ARK, this oversupply will cause it, just by the weight of it, to fall on itself, on its own, right? Just the weight of the issuance. And he was very bearish going into the second podcast, and then webinar, sorry, which is also a podcast now, by the way. And then sure enough, whoosh, the floor just gave sway, and ARK has a lot of SPACs. And in fact, they also issued some changes in their composition of what they're going to do in regards to the SPAC trades. But one thing that Craig did also said was, when we have this washout low, these warrants, when we have a real washout low, will be extremely great plays. They're 10 cents or whatever. Just stick them in a drawer and forget about it, because when the market does come back, and it is an asset class, it will come back. Not all of them, of course. Go with the best, in breed. When they do come back, they'll be worth a lot of money. So that, just an answer, Peter, that's, one trading strategy in regards to SPACs. But right now they have fallen from grace as an asset class, and a lot of people were hurt. A lot of new traders were hurt who came in, made an enormous amount of money last year, got into this, what do you call it? Gropey? Something action.
Gorpy.
That's a much better word. Okay.
Yeah, Gorpy action.
Gorpy action.
Yeah, where it just there's no sell side to it, and it just kind of just keeps getting bid up, and it goes on and goes on and goes on. So like that's the Gorp. I call it the market Gorp, where boom. And then that's exactly what you see. And where once a significant selling event starts, then it clears out everything. If you look at that particular SPAC chart, it went right back to the previous kind of high, yes, right? And so high came back. So that's where it was tested out.
Yeah, when it was
the issuance. Yeah. So if you look at to me, the SPAC thing, the Momo trades that started either in November or January, and they, these things are like, we were getting, just hit them with them in the face every day. It's like nonstop, TikTok videos, the whole 9 yards, like all of that stuff is like here, if you like set that over to the side, and then you've got, which I would call like really hot, fast money. And then over here, you have the indexation, the passive indexation, you got volatility, and that whole sphere, I'd say. And then you have like Cathie Wood and the concentrated positions over here. They're all different things to me. Like, so like you are seeing, and we talked about legs of the table getting knocked out and what continues to carry this bull market on. And we're kind of, I think we're totally in the final innings here, because you're starting to lose your retail, like chasing, nouveau, trade situation. I've seen more like, I can't believe how much money I'm losing posts in the last couple of weeks. And I'm just like, what are they, what were people like mass levered in LaDuc?
I liked it. Are you kidding?
I think it's great and everything, but it's just too far too fast, right? So like
we
everybody's
talked about Wix too, right? And
yeah, 100%. Yeah. So like these are all great things, but in the long term, on a mean average, they'll be fine. But in the short run, they've gotten so extended past any type of fair value that they were gone. So like you have those been knocked out. You've got Cathie Wood and the concentrated position bunch over here, and they're struggling. Can they bounce back? We'll see. Then you've got kind of the passive indexation ETF environment that's still chugging along, and and that is the biggest one in the room by far, and the institutional order flow as it relates to options, and that is the largest players in the room, and they're still bullish, and they're bullish because inflation, right? Until there's some significant change. Now we're kind of getting to I would say to the tail end of this thing where, there's, Biden changed his thing from 3 trillion to 4 trillion on the infrastructure. And then they're throwing out another stimulus of some kind next month. There is some breaking point. And that's what Griffin was saying. It's like, you got to be on the lookout for that. And that indexation. So if everything else underneath is falling apart, if all these different pieces are falling apart, then, there is only a matter of time before these real ones are put to the test, right? And I think that's really where we're at this point.
Did you see the article that I tweeted, but also just put in chat? Just wanted to get your thoughts on this. It is the rotation, for lack of a better word, from passive to active investing again. So it was an article that popped up that caught my attention. The resurgence of active trading. Maybe you know these guys.
Anderson Works. Yep.
But I really, this is interesting to me. Equity funds, active versus passive, they are starting to catch up. I really liked this particular mapping of fintech platforms. I only know, I don't know some of these, but I know all of these.
Mm-hmm.
But they're definitely seizing on this whole, revolution, if you will, of folks coming in to manage their own wealth. And by the way, women have opened up more accounts at Fidelity over the last year than men. That's a new one.
I wrote an article at the beginning of the year that they put. That got published in tab form, I think, in a couple other places. It was like the return of active. And that was in January. And I thought I haven't read this Anderson Horowitz one out, but I'll read it. It's the technology, if I give you my real opinion, like right here, I'm not like real bearish, like overall, like I'm bearish, like the passive structure, right, of the ETFs. And that's kind of got to go through some cleansing situation of some kind. And can we get through it? But I'm kind of bullish of the fact that there's so many people wanting to get involved in the markets, and the liquidity that brings, and the speed with which people learn this stuff, that they're getting involved in it. Like you're talking about, like, young people, women, like you name it. Like, and as the internet comes online in other countries, and I may have mentioned this or not, but I mean, we work with the exchanges directly all the time. And I was speaking to NASDAQ, and they said there was more orders for American equity index access in Asia, like, Southeast Asia, Pacific Asia, the Asia Pac environment, than the United States by like 6.
Wow. To
access U.S. equity days. So like, you figure other countries come online. We're the most kind of mature market in the world. not perfect by any stretch of imagination, but
Also
a
the
highly mature
biggest,
market.
most liquid.
Right, exactly. And I think as more people get involved, it's very hard to be like, cataclysmically bearish with that kind of structural thing taking place, with a lot of people getting involved. And the apps are actually migrating to being just straight, transactional things, to exploring and discovering. So I think that the ETF piece is like got to experience some sort of event to clear that out, because that's such a tied piece. But the options market is wagging that dog right now, in my opinion.
The active side, they're still institutionally not very active in the passive
Correct.
world.
And that's what I'm referring to, that institutional level passive indexation that is created, and think in the concept that that's just going to continue to persist. I think that has to be the last thing to be taken out before you see some next generation market that exists.
But you're right. And you've also talked about the fiscal monetary combo deal is going to bring not just a lot of liquidity, right, into the system, via the Fed, but also the printing into the consumer's pocket, whether they consume or whether they pay down debt or whether they invest or whether they speculate. So it is to be determined. This second wave, if you will, of stimulus checks seems to be going into, or expected to go into, spending and paying down of debt. But we'll see.
Hotels. I saw a statistic yesterday. Hotels almost to 80% capacity in some states.
Wonderful.
So like people are getting back out there with the vaccines and so forth. So I think the people are taking that money and more towards debt, more towards car buying, more towards traveling, house, first house ownership, things like that. I don't think that's coming into the market this time. So it's not a tailwind for the market, I believe, on this go round.
So now we're talking about inflection points here, higher, lower, as we've really been grinding about, and this the Russell pullback of 10% is nothing but a blip in regards to its relative strength over the past few months. And this quarter in particular, energy digesting the past few weeks after the oil, drop of 7% in one day. And then, of course, everyone's like, whoa, wait a minute. And sure enough, there is reason for it. It was way ahead of fundamentals. But when I look at the whole cyclical trade of, okay, value is still working, money's still coming, there's a bull market somewhere, dollar is still trading higher, gold lower with bonds, all of that to me makes sense on a macro side. But there was a good question. So the hedges obviously aren't working. But what about crypto? It has held its ground extremely well. Are you bullish or bearish this, recent push? But I mean, obviously it hit 60,000 and it's kind of digesting in a $10,000 range for Bitcoin and then lots of other cryptos. It has not, from my, technical analysis, the Bitcoin proxies, whether it be MicroStrategy, Mara, Riot, the very popular ones, the more liquid ones, and the ones that have a lot of, of course, GBTC, the ones that have a lot of Bitcoin on the balance sheet, for example, have not taken out their February highs. So they're still digesting, but they haven't broken down. And that is still serving as a hedge, or a better hedge than gold or bonds or volatility, which is still breaking down. But big picture, that's the one leg of the table, right? In the hedging world, that has not been taken out. What are your thoughts on that?
I would have to say I saw the comment earlier in the thread. I think that it's a liquidity thing where there's just still such a liquidity abundance that can go to that, and desires to go to that at this point. And that hasn't been tested in any way, shape, or form. And I think you were the one maybe 2 weeks ago, or I'm going to say it was something about that point where you were like, I want to see this tested.
I do.
Right. I want to see Bitcoin tested. And so, I think that's probably, it's probably a fair shake. I think that like, until there's liquidity choke on that, then that probably remains pretty bid on dips, and it's so accessible to an extent, from like the most So let me give you guys some perspective. So most apps and most exchanges at this point are carrying Bitcoin and Bitcoin proxy and all the different coins, at least the majority coins, the all of the kind of Ethereum and I don't know all of them, so I'm not going to sit here and kind of butcher that, but there's a lot. Every time I talk to an exchange, they're not scrambling to get it in, but they are actively getting these indexes, getting this ready to be indexed and stuff like that. And so to me, that means there's still a demand, and the demand is still steady and growing versus going the other direction. And the liquidity is still coming into that. So, is it as strong a liquidity? I think this is latecomers, but I think that you run the risk here if you get bearish on it right here, the same way you kind of get bearish on the indexes at an inflection point. If it's not breaking down, there is excess liquidity and you don't have significant volatility, then you got to give the benefit of the doubt probably to the upside. Now, be it, it's kind of much more dicey here than at like 20,000 or 10,000 was. That was, much different kind of upside action move. But this could be, you could see another breakout situation if it doesn't break down. And that's where kind of the whole picture, I think, as a whole, I have is that I don't know if IWM makes it back up, because most of the push, I'd say not most, but I'd say a good 45 to 60% of the push in IWM was these Momo stocks. I don't think they're there now. And I think that but the major indexes, they're at inflection points with the absence of volatility, liquidity coming into them, and excess liquidity on the sideline. To take a short side bet is pretty that's speculative in my point.
Let me go over a few notes though. I mean,
I'd say the same thing. Bitcoin. That to sum up my position is I find it hard to short that right here.
It hasn't broken. I completely agree.
Yeah.
But as a hedge, I mean, one thing that a comment in chat was that institutionally, it is not a crowded trade. I'm showing a chart that this is Bitcoin position, based on open interest at the CME. These are futures contracts, and obviously it has traded like a commodity. So for me, Bitcoin trades like a commodity. And why I said I wanted to see it tested as the dollar goes up, which was the thesis, right? 93 and then 94, then 95 in the Dixie. I wanted to see how Bitcoin would process that because it's dollar based. I want to see how that does. So right now, this is very busy and strong trend that has not broken. We do have the Bitcoin mini futures coming up May 3rd that just got announced, I think today or yesterday. So that is, some will say, oh, that's going to be the shorting opportunity when it becomes, the mini Bitcoin futures is like 1/10, right? And the question is, will retail really be trading futures?
No, I don't think, not at all. So because if you've seen a futures push, you would have seen it in this last retail push, and you didn't see that. The push was to options. So retail's got their hands and arms wrapped around options, and so are the apps. So no apps that I'm aware of are actively trading futures.
But the dollar is still moving higher, right? So it just broke out. Really, this is a daily, but I've been showing this chart, and I'm still bond and gold bearish. This is gold inverse, right? And this is the dollar. So this is just taken earlier. We're still moving higher. I do still see this is 93. Obviously, I'm wrong. That comes right back in, but we're still moving higher. Let's see what Bitcoin does. And then this was pushed out. Big picture from Plan B. Anyone who follows this, I think, knows who Plan B is. 100 trillion is his Twitter handle. And his quote was, "We are only 4 months into a bull market and nowhere near the end of it. Bitcoin is just getting started." So it is very tough to, discount it as an asset class. It definitely doesn't have large institutional sponsorship, but it definitely has a large, retail, what do you call it? Stimulus checks, excitement went into it as well, and it trades like a commodity. It hasn't been tested. yada yada, and it still has the
Well, I
Powell
give
blessing.
yeah, I'll give you a couple thoughts on this. You can't get institutional acceptance with such a standard deviation, right? So that's part of the problem, that you're not getting as much institutional acceptance because it falls outside the risk parameters. So it's hard for them to allocate to it when you see a 20% drawdown, a 20% rise, 30% up, 30. Yeah, that is like one of the major issues with it getting to the major wirehouse level of acceptance. And until that changes, those models they're not gonna buy it just sheerly out of rules, right? Like you are seeing hedge funds take positions in it to avoid not being invested, but that's still not like a concentrated speculative position like a micro strategy. So you've got there's just, by the default nature of it being so volatile, it basically discounts itself to being accepted at the institutional level based on just rules. So that's going to be something that holds it back, which keeps it to it's still going to kind of be not manipulatable, but it's controlled by as something that has a finite set of units, right? And that doesn't have all the players in it. And that's why I say, like, people say like, oh, wait until the institutions get involved. It's like, but they don't put the asterisk on there that institutions can't get involved with something with the high standard deviation at all, and they have to change the rules. So like those statements don't throw that out. So what's happening with Bitcoin is, you got players in there that are sponsoring companies that are potentially taking speculative positions. So Morgan Stanley has been involved in a lot of things over in China, and that name keeps popping up a lot in the circles with sponsoring companies that are taking speculative positions. So I think that that's kind of a little bit of a workaround that's taking place with that, and you'll continue to see this be kind of a violent vehicle for the foreseeable future until something is determined as far as the regulatory environment with the U.S. government. I don't know how that shakes out. It's so funny you brought this up, because I actually was thinking about that today, just randomly, because I saw Chipotle post something about got Bitcoin or something. I was like, oh, all right, so I'm going to be buying like my burritos with Bitcoin now. And it's starting to get to the point where the U.S. government has to address it at some point here shortly being in sometime in the near term future, as to is this a mechanism of payment or is it not, right? Is it going to be like a structured vehicle, like where you're paying with Zelle, or something to that effect? So I think it's a totally, I have no position in it. Honestly, because like we're in tech, so it's hard to that'd be like me doing my best Cathie Wood impression to get super concentrated and things that are changing things. So I don't take a position in it. I don't have a position in gold either, for what it's worth. So like I'm not sitting here gold bugging it, talking down Bitcoin.
I was just asked about gold and silver, so let me just kind of comment on that, because Bitcoin for me is still a fabulous alternative. I just think it's a great alternative investment because of the fact that it has such speculation and sponsorship. But I love to pick apart the whole concept that it's the networking effect. Price doesn't matter. The thesis that what matters is owning a piece of this network, and they're constantly referencing network effect, Metcalfe's law. So Bob Metcalfe is the one who came up with this networking effect, kind of catchphrase. And the funny thing is, I went back and looked at his comments on network effects and Bitcoin, and he said one trouble is that the value of networking is very hard to measure, which I think is also the bear case, right?
Yeah. I mean, there's a comment that says, Bitcoin's crazy volatile. How are we going to call it volatile when Viacom, got cut in half in a week?
Yes,
it's a fair statement. The problem is the way the institutions are set up, right? They don't consider the volatility ranges inside a period of time, right? To be, it's just the way their formulas are structured.
I
I'm
call the
not gonna I'm
aura
not gonna
of
argue with
yeah.
the volatility at all. I'm arguing with the way that they set it up. And Bitcoin experiences, so Viacom didn't experience volatility for a while, and then it just got wiped out, right? So it's worse. It's worse than being highly volatile over a period of time. But the way that they set their stuff up, that's why it's not going to be institutionally, accepted for some time, until the way that they run their formulas would change and they consider it an asset class that they can basically, it's a CYA deal,
Yep.
right? I'm not going to offer it to my clients unless I can CYA. That's the problem. And nobody can CYA Bitcoin, especially when they can't figure out exactly, a lot of them can't even explain it, right? They can explain Viacom, people use it, but they can't explain Bitcoin.
Well, there you go. So on the gold and silver trade, I am still bearish, and bearish bonds too. There's been no stabilization, no pattern, no higher real yields to justify anything else than just continued choppiness and droppiness in the precious metals. But I know folks are getting very anxious about that because they're not converts to Bitcoin, and they see the fade continue in gold down 15-20% since the August highs. Bonds continuing, to just not go anywhere fast. And silver was the last one to fall. So this is kind of interesting that we actually had a solid drop below the 200-day finally in silver, and not since May 15th. So, and interestingly enough, it's tracking the strongest with the dollar. The dollar, for the first time since May, is above the 200-day. So anyway, I still see both the bond and precious metal trades lower for the next quarter, and then Q3 they will start to get defended, and Q4 I think they'll be much stronger. But unfortunately, I don't see anything but just choppiness in precious metals. And you just talked about the aura of volatility with Bitcoin. I mean, something that moves so dramatically is very hard to kind of gauge. So that's, I think
Yeah, to throw in my 2 cents on the precious
dollar doesn't
metals.
move like that. It's very slow.
Historically, the PMs, like if you look at the 2010 to 2017 period, they would get just violently attacked on a market structure basis. Like you saw the massacre, back in the 12 and 13 time period, and the selling was really like serious. This time it's been pretty orderly. I was actually looking at that before we got on, just kind of, I try to take a look at different things, considering we might discuss them. And I'm just not seeing anything in that structure that's like really super concerning as like a major breakdown. Like we're hitting the 200 area right now for like silver, right? Gold is still, finding its way there. GDX is looking soft. These things but they don't look like they're falling apart. They look like there's no liquidity flowing that direction. I think when there's something that's got, a positive market structure and a wider, perspective. So if you zoom out years on the PMs and you look at the levels to which they're retracing, these are really solid hold levels, right?
Wait a
Potentially.
Wait a minute. Wait a minute. So one thing, let me just say with gold, and then show you a monthly, because I think that kind of allows that pulling out feature. The macro for gold really is this. I mean, it can be used as calamity hedge, inflation hedge, commodity, all kind currency. There are lots of reasons that gold is in a portfolio for sure. But in regards to outperformance, it's when real rates head lower, and negative rates are bullish gold, and we have been turning the channel, and this kind of trend, if you will, of the steepener in the yield curve, which I think is going to flatten, which could be bearish equities sooner rather than later, but it hasn't yet. So negative real interest rates are bullish gold, and inflation adjusted real rates heading lower is when gold outperforms. So that's kind of the macro backdrop. And then this is gold with a little bit of the dollar yen just as a kind of an overlay. I know this is really messy, but just bear with me. It's part of my intermarket. So here is gold continuous contract on a monthly, and you can see when you're just talking about pulling back in time, it's a gorgeous kind of like scoop. Maybe this is a handle, and then we shoot up higher, and that's what everyone is really, buying or positioning for. The problem is this is on a massive trend line from 2001. It is also correlated inversely to the dollar yen carry trade, and you can see that this the dollar yen is poking up higher, so it's broken out. The gold, this is by the way, doesn't include today, is looking like it wants to break down. My intermarket stuff is going to be very noisy, but it basically means it's on its way to zero. So gold is
Oh,
still.
those they didn't agree with you. My dogs didn't agree.
I know a lot of folks who don't, but to me, this just still says caution. It definitely needs to, I think, overshoot that trend line on a monthly, then maybe get very quickly supported and head higher. But I would say there's still weakness in that complex. So
I had a target on gold at 1500, 1450.
yeah, that's
What
exactly, yeah.
that's the target that I had from a market structure perspective that I thought I'd probably revisit, because it just got really carried away.
Yep,
And
same thing right here, which is in this channel, which again, this is gold inverse and this is the dollar. As this heads higher, this is coming back down to that channel. Yeah, we're, potentially.
yeah, and I had a target on silver at like let me look at that real quick. I had a target on that, and it's not anywhere close to that. And I'd love to see it come back. Like SLV is 1750, right? 1750 area, something to that effect. So that'd be about $18 in continuous futures, 1850. And so I don't. That's what I was saying. Like maybe I'm just being greedy, but like I think that these are setting up like nicely. I think they're going lower, for sure. And I think that they're not even close to done, but like still fairly orderly. And I go to interesting. We had the margin liquidations last week, right? Like the banks and all that's talking about. And gold is a tier one asset. Okay, and it's one of the tier one assets, right? In a lot of classes for liquidation. So, if you see these types of events occur, that can be where, gold gets hit, kind of 2%, 3%. And it's like where you get those kind of standard deviation moves. So this may not be correlated at all, but we're starting to see a little bit more, volatility in that space. But sometimes those things can correlate. We did see that last week. Until something changes with the banks and and especially like the central banks around the world. And I'm not trying to go like full on, gold bug, conversation or Jim Rickards here, but like, I think that, my target's 1500, 1450 to see if this stuff has any merit in the buying space any further. I think that's where you'd see institutions step in with what they call back up the dump truck. If that's where you would see, which could correlate to these rates areas that you're talking about right now.
Well, let's talk about, since rates are still in play, higher yields, and since tech is a duration play, this is something I've shared with clients before, which is basically a stacked chart of, your semis, IPOs, financial services, internet. IGV is heavily weighted with Microsoft. Hack is cyber. I could go on and on and on. But the point is, these are technology sectors that are just, forming head and shoulders, digestion for months, right? While small caps and value and cyclical and commodities and Bitcoin have done really well, relatively speaking. And this is just not looking really ready to turn higher. So how do we, and kind of answer to that, how do we get this this move to get us to 430 in SPY, or 4600, some have it? How are we going to do that when we have extreme sentiment right now? Also, I love these charts from Suburban Drone. If anyone follows him, he's very much bearish, but I love his charts because they make me think every single time. Margin balances, all-time highs, and the divergence between global NASDAQ on a weekly and its, 200 week is far below. And the same argument can be made for cyclicals. This, and I've done this with clients as well, where we've got massive amounts of gaps higher, whether it be financials, whether it be, energy, not as much energy, small caps, but also energy, across the board. There, and I put this little orange arrow to kind of emphasize huge. This is not a gappy product. At some point, and these are the high beta cyclicals, right? So I just showed you global NASDAQ. That was a great chart of his. And now the high beta cyclicals. Also, again, percentage of these stocks above their 200-week moving average is just unprecedented highs. When we do have, like you were talking about, this gorpy action, and the air pocket, or I should say leverage right now, and then creates this air pocket of risk. I think both, when we do have a sell-off come, both tech and value, momentum and anti-momentum, can sell off aggressively together.
100%. Yeah, totally agree. Yeah, I have no argument to that.
Where are the hedges? And by the way,
well, go back to the first picture he had, and I'll play devil's advocate on this.
Go ahead.
When you look at 18, right? It's 16, 17. I can kind of make out, like, it's 14 is the first year, 2014 on the left. All right. So Robinhood becomes very, very, very prevalent, like, 18 and on, right? 17, 18 and on. And that's right, really after that 16 area.
Yep.
And so you have a whole new kind of universe of people that are, getting into the market and taking on margin that weren't even in the market. Correct. And so sometimes when you look at these statistics, I don't want to call them like, chart crimes or anything like that, but it's almost like you got to like add a second level of information in that, in the sense that what are the other ramifications that could lead to such a high margin environment, right? So Robinhood doesn't even require you to fill out paperwork, right? Like TD Ameritrade does for margin. You just simply do a couple of clicks and you got it. So that it did contribute to this. So we are at a high level, but we're at such a high level. How much of that is like actually, concentrated to there, or is it because balances have increased 150% at the institutional level too, where people keep taking on margin? Like if you're at like a Raymond James and they're like, hey, you can take on margin too. So people are net long, which I think is a negative thing. And don't get me wrong, I'm not cheerleading the situation. I'm just saying that what can take it higher is that exactly the thing that's taking it higher at the moment, which isn't necessarily a good thing. It's just that it's inflows that are sitting there because the equities have gone up and the equity in those accounts has gone up. And so the margin allowances have gone up too. Right. And so it's a feeding loop that I don't really, to me, honestly, it's the liquidity.
Yeah. I'm not so much worried about the margin as I am the leverage.
Well, look, like once everybody once you got an account, you've got $2 million account, and you've taken on more margin on that, right? And then you then you're zero real quick, right? And so, to the Viacom point a few minutes ago, if you're holding the wrong stuff and you get halved, then you're on margin, then you're lit up, and that's the end of the show. Yeah. So that can happen real quick, and that's exactly why you're right, that at some point it all will sell off together, because of the way that it's rolling together. But it make hay while the sun is shining is how they're structuring this stuff, right? Why be short? Like I got an anecdotal call the other day. I wasn't long enough, according to my brokerage.
You weren't long enough?
I wasn't long enough. Yeah, I wasn't long enough. So, quote unquote, like, you should be taking on more. You could take on more. You're too much cash.
Houses and taking cash out. It's the same kind of.
Yeah, you've got too much cash, right? Yeah, so it's like, yeah.
Yeah, but this is also, the article that I just had screen shared is long short hedge funds, even though they're, off, if you will, because of that growth value momentum factor rotation, they have been still 201% leveraged. So
Yeah,
this
no, I mean, we're levered up. We're levered up, but we're levered up across the board. Like we're levered up at
across the board, and it
from the
wasn't just at the
government
bank top.
level all the way down, right? It's
Yeah.
just it's all levered up.
The Robin Hood GameStop, was levered. The
Hmm.
Tiger Cub family office was levered. Hedge funds are still, retail is still, everyone's levered. And
And
if they're not levered
volatility,
enough, they contact you and say, please.
volatility to me, the last thing I'll say, volatility will give you some inclination that there is some trouble, and you're seeing none in the term structure and in the SPY, SPX and the Dow Jones, and you're seeing some in the IWM Russell, right? And then you're seeing a little bit in the Qs, but that vanishes pretty quickly until you see vol like really like to pick up to me.
Yep.
Then you just it can be a little bit before it starts to turn over. Now it will catch up. It will catch up because once everyone does get nervous, they're going to get
Yes.
nervous simultaneously.
So this
So
is my
you'll see it
warning.
compress.
So
Yeah.
this is my warning, and I think, we've already talked about this, that volatility, for me anyway, is going to have waves through June. And I think June is going to be potentially, some buying opportunity. But for right now, I think this is going to be waves, big, volatility bursts, and they get sold, another big volatility burst, and it's going to be like that for a few months. But here's just an example of intermarket when you're talking about there is no volatility. So here is right up here. This is this is Nasdaq. By the way, this is a McClellan summation ratio, and it's intermarket, and it's really busy, and you don't use this every day. But the point is, here's Nasdaq up here, and here's the selling under the surface. And traditionally, when this hits zero, it's not at zero right now, it's at 1468, doesn't matter. But when it hits zero is when we get volatility. So I use this as an indicator of, okay, so we've had lots of selling under the surface, right? But we haven't had any volatility yet. So I use stuff like that. And just as kind of like, because we do this every Tuesday, and if you join, I kind of join in both conversation or listening. I'm grateful. Jonathan is grateful. We love kind of figuring out the puzzle of the market. And one thing in particular that I am puzzled by is the strength of the market backdrop when it intonates over and over that it's going to roll over at any point. And this is a case in point. NYSE, which is a composite index I happen to like to chart, has been like, look at this tease. 1, 2, 3. This is the MACD. Still hasn't rolled over. Extremely overbought. And yes, stuff can stay overbought, for a long time. But remember this, we talked about this, months ago, and it still pulls back. It's like stair step. That's what worries me, is the higher this goes, the more gorpy action, the more parabolic that it goes, that equals trapped longs, equals liquidation, equals Viacom type event. Maybe, hopefully not. But the point is, I can see this coming crashing back down. Eventually, hasn't triggered yet. And the same thing, when I do my intermarket, which is the percent of stocks above their 50-day moving average. We're talking 2018 here, right? Here we are. This is where we broke out. I'm like, dang it. And here's this trend line from, guess what? March 23rd, Fed intervention low, right? We keep coming close, but we haven't failed. And when we do, it's typically boom, right? So, and that was, by the way, January 2018. This was October through Christmas Eve massacre 2018. This was 35 days and 35% pullback between February 24th and March 23rd. What's coming next? So
Yeah.
I keep doing the same thing with you. I'm like looking, going, okay, we could go higher.
The difference that I have versus those areas is just there's just no vol, and the options are just all call side. Even when there's the slightest kind of drawback, you're seeing just this massive call side. And when I see something change like that, I'll be the first one to jump on the gas, because I'm much more inclined to be bearish than bullish in markets. It's just historically how I've always felt, because it's just so much more fun and fast, right, to be long vol and short indexes. But at the same time, I don't have a green light to these things, and these things have just been meandering and it becomes like a time frame issue, right? They can meander for a couple more weeks, they could meander for a couple more months and continue to break down. And that magic elixir, like all of your intermarket stuff is starting to like, show problems. And I was looking at your portfolio hedger, and a bunch of those are all, hedge volatility
I'm
or
confused
flirting
by
with
that
neutral.
too, right?
And well, it's really that they, when we threw in the neutral, because they're flirting with it, but they're not breaking down. Like
Nothing's breaking down, nothing's
yeah,
breaking up, nothing's confirming, but you can see the charts, they keep intonating that they want
it's
to.
so you got to be. So that's why I say you got to be cautious that you could get bear trapped, right? Because that could be really painful to be very short and then to have the roof ripped off. Although a lot of, so you just got to know your levels of if I'm short, know my levels where I'm gonna have to clear, cover, and get out because it'll rip
But
because of the one time frame stuff. But if not, it could go like it very much could go anytime.
But at the same time, every word he just wrote in chat, just hanging, as long as the Fed balance sheet keeps going up, and I've heard estimates, from 7 to 50 trillion if needed, then it's going to be hard for crashes to stick. They may be episodic events, but they will be bought. Now that's what we are expecting. But
Yeah.
in the meantime, it could be very dramatic, right? Like a Viacom, not per se, I'm not saying we're going to drop in half, but my point is when it happens, it forces folks out of the market because then they become ill-equipped to handle that kind of volatility.
Well, I think ultimately the number one enemy of the Fed is volatility, right? Because it keeps people out of the water, and they want people in the water, and it puts the pension stuff at risk, which is all, it's just a paradox. Because, and I'm a broken record with all this, but it's like,
No, but it's good to remind. You're right. We can't have volatility, or else it'll reprice pensions, and the Fed won't allow that. So,
and so it's a paradox. And so, can that game continue? As long as there's the perception that it can, right? Then it can, right? As long as the preponderance of players want that to continue, then it can. So I'm like, volatility doesn't lie. Volatility tells the truth, though. Always does. It told the truth back in March. Volatility told you the truth when it, really had nowhere else to go. It was at 100, and really had nowhere else to go, so it was done. And they sucked it out of the market, and everybody got back in the water. And so I think, until you see some semblance of volatility in the term structure and of the major indexes, and you track that, for people who don't want to track it, they can just, grab the portfolio hedger. But if you track the term structure and a couple other factors in that, then you're able to, kind of get your heads up when it's coming. Because and I'd say it's heads up time right now, because it's all, neutral or negative, neutral or bearish. So it's there, it's just not sticking, right?
yeah.
And so when you say, it's hard for the crashes to stick, it is, as long as the ETF indexation is overwhelming the situation, and the levels of the market are buyers levels. And so if the levels of the market are, let's say, 20% to 25% lower than here, you can see those things. They'll be buying events. If you get 40, 50%, like from where we are, which it sounds crazy, but like, just bear with me, then they will reassess those formulations. And then you're going to see some sort of clearing event, where I'm talking about where the ETF structure itself has to be thought through. So I'm until you see vol like rear its head, in the major indexes, and you see the options positioning change, then you got to give the benefit of the doubt to going higher, especially when you got this clearing of this Momo trade stuff. The Tesla stuff has not knocked this off. Then, just by proxy of liquidity, and levels of where money's going to come from the sideline and come back in, right? You can see things go higher, and margin balances can go up, and everything else.
No, that's it in a nutshell. So we have this continued gorpy, manic, choppy market. We'll try to make sense of it next Tuesday, again, with whatever happens over the long weekend, which also includes non-farm payrolls on Friday when the market is closed. So for
That's
those
fine.
who are still here, keep in mind we have a short week this week. Friday markets closed. We've got Passover, Easter celebrations into a Tuesday Amazon vote for unionization. We'll see if organized labor makes a comeback, but that would, force some potential, wage inflation thoughts. Otherwise, there's not a lot of economic data, just eyes on the dollar and volatility, gap fill 1821. I'm still determined that we're going to get down there, which means SPY a little bit higher. Let's tag that 1821, some kind of form, as far as basing before we can have a nice volatility event. So I still think we can grind a little bit higher, but I'm not so uber bullish, even though we've got
Yeah, totally.
I'm not uber bullish. But this will be posted on my LaDuc Trading YouTube channel here. So please subscribe, hit thumbs up if you like it. If you don't, let us know why, what you want to hear more
Yep.
about. I think that would be also good feedback. And this is VigTech. Jonathan has a new launch coming out, including a new options product. Cannot wait. You can find both of us on Twitter, and we will be back here next Tuesday. Thank you.
Thanks, everybody. I appreciate it. Thanks, Sam.
All right. Have a great week. Bye.
Bye.